Welcome to the AICPA Town Hall Series, your resource for the latest news and updates on pressing issues facing the accounting profession.
Good afternoon and welcome to the AICPA Town Hall Series. I'm Eric Auskerson, one of your hosts. Hope you all had a wonderful 4th of July holiday. We've got another great show for you today. Lots going on. We're going to give you some timely updates from our team in Washington, D.C. Also have a great small business discussion that we're going to have with one of the leading small business experts in the U.S., who's also a CPA, Gene Marks. And then we're going to provide a number of technical updates. So here is the lineup. I already kind of covered a couple of the items that we'll be reviewing today. And who I'd like to bring up first is someone you all know, Rachel Dressen, who's the Senior Director of Advocacy out of our DC office. So Rachel, it's great to have you with us today.
It's great to be with you, Eric.
Well, Rachel, we've got Congress back in session. They've been in session for about a week, and they've got 2 weeks until their August recess. Lots going on right now. So let's kind of, cover, some of the top items.
Yeah, it's a busy month for Congress. They just got back from the July 4th recess. And as you mentioned, they're in for 3 weeks. This week is pretty much over. So just 2 more weeks until the next recess. And they have a lot that they are hoping to accomplish in the next couple of weeks. We'll see how much they're able to actually get done. One of the items is the NDAA, the National Defense Authorization Act. This is viewed as a must-pass bill. It's passed Congress every year since the 1960s. So this is an important bill to give authorization for our nation's defense. And the House is considering this bill this week on the floor. The Senate is planning to consider the bill on the floor of the Senate next week. And, it might then go into that last week of July. But that's the plan as of now. This is an important bill. I'll just highlight one item in this that might be of interest to the town hall. It's something that we're following because it has to do with consulting work. And this is really just focused on China. As we've talked about before in the town hall, there's a lot of bipartisan interest in trying to combat China. And this provision in this bill that we are watching is really related to that. And what it does is it prohibits DoD from engaging in consulting contracts with firms that provide consulting services to, and they list out some different entities, and what's included is the People's Republic of China, the Chinese Communist Party, the People's Liberation Army, and they also say other entities that are either directly or indirectly under the control of the Chinese government. So as you can imagine, that's a pretty big group. And so this bill would prohibit these contracts, and it would also have a reporting requirement that these firms would then have to report any contract work that they've done with any of these entities that I've listed over the past 5 years. So this is pretty broad and sweeping, and this is in the House bill. There's a similar provision in the Senate bill that has to do more with just a reporting requirement and doing any work with China and having a conflict of interest mitigation plan. So that's something we're following related to the NDAA. Another issue that Congress is trying to address this month is the fiscal 2024 appropriations bills. We've talked about this in previous town halls. The debt limit deal requires that each of the 12 individual appropriations bills are passed by the end of the year. Otherwise, there will be a 1% cut. So they're trying to get as many of those bills done as possible. They're working in them through the committee process, and then they'll try to bring them to the floor. In the House, they are considering this ESG month in the Financial Services Committee because they're holding a number of hearings related to ESG. This is, a very political, partisan issues. So if you're watching any of these hearings, I don't think you're going to see much bipartisanship, but they're having these hearings, and then it will likely culminate at the end of the month in a markup of some various bills that have been introduced. And then lastly, the town hall might be interested in some bills that Senate Leader Schumer has said that he hopes that they will be able to vote on in July. One of them has to do with cannabis and financial institutions and providing protections to these financial institutions. And included in there is ancillary services, which would include CPAs. And then also, we've talked about some of the recent bank failures on the town hall, and there is legislation that's been introduced that would have some clawback provisions for bank executives and some of their compensation. So there's a lot they're hoping to get done in very little time. We'll see how much they're actually able to get passed on the House and Senate floors.
Well, Rachel, lots of questions coming in here. A couple of questions that pretty much come in every town hall. One just on ERC and just anxiety that some firms have their clients using one of these ERC mills, and so any kind of latest update from the IRS related to managing this situation?
Yeah, no, this continues to be a big issue that we're hearing a lot about. We're hearing it from practitioners. We know that members of Congress are hearing it from their constituents. The IRS, as you mentioned, is keenly aware of this. It's something that we're following very closely. As far as any legislation on ERC, we don't see anything moving this summer. Any tax legislation is probably stalled until later in the year.
Okay, well, talking about just September, moving into September, and all this talk about a government shutdown. We've got two quotes here from one member, both from the House, two Republicans, one from Florida, one from Virginia. So what's the likelihood of this? And you've seen this many times before. How are you forecasting what's going to happen?
Yeah, for those who have been watching the town hall since January, you probably feel like it's a broken record because we keep talking and warning about a potential government shutdown. It was in the context of the debt limit. And now that that's been passed and they're working through the appropriations process, the likelihood of a shutdown is still very real. And, even, more so than it was before as we get closer and closer to the end of the fiscal year and we get closer to October 1st. As you can see, there are members of Congress who are not fearful of a shutdown. And as these quotes illustrate, they almost welcome a shutdown. And in a divided Congress with the very slim majorities, it's going to make it really tough for the leaders to be able to pass legislation to fund the government. This is something that we're following very closely because, of course, it would impact all the federal agencies, including the IRS and everyone else. So this could have a significant impact on the profession. So we're monitoring it as they move through all the various appropriations bills.
Well, we will be, even though they'll be in recess in August, I'm sure there'll be a lot of discussion outside of Washington, D.C. related to a potential shutdown. So as you said, it's ESG month or ESG week right now. So, for the town hall attendees, let's just kind of step back and talk broadly about, where things stand with ESG and what we see potentially happening over the coming months.
Yeah, because it is what they're calling, ESG month in the Financial Services Committee. ESG is getting a lot of attention right now. This is an issue that, of course, we've been following for quite some time. The SEC came out with their proposed rule on climate change disclosures last year. We've been awaiting the final rule. They have been working through all the comments. There were thousands and thousands of comments, around 15,000 comments that they have to go through. It looks like it might not be until the fall that they actually come out with that final rule. But in the meantime, Congress has certainly done their part in taking action through hearings and through introducing legislation and writing letters. They've sent a number of letters to the administration, to the SEC. And as I mentioned earlier, this is a very partisan issue. This is an issue that really unifies each side. It unifies Republicans against ESG, and it unifies Democrats in support of ESG. And so we've seen that in the letters and the bills that have been introduced. And not only has there been the SEC climate proposed rule that has come out, but there's been other executive actions that the administration has taken. One of them is through any federal contractors who do work for the government, that they would then have to disclose their climate emissions. So that's just another example of some ESG related activity that is going on here in DEC. And then, of course, we've heard that the SEC is working on more than just the climate change disclosure proposal. They are also working on a proposed rule on human capital and board diversity that we could see really anytime.
Well, Rachel, and what we just covered here was some of the regulatory drivers of ESG, but clearly there's other market forces out there. There's the continuing convergence of the standards, and also just forces from investors, from customers. So this is multi-pronged. And I've heard recently someone predicted, you just said maybe September, October. Someone said maybe a Friday in August, the SEC will release the final disclosure rule. We'll see. Everyone feels like something will come out this year, and the question is just when.
Yeah, I think that's exactly right. The question really is when. We've been, waiting for months now. So, it could, as you said, could be August, it could be fall, really any day. We keep waiting.
And what I'll say is I do know firms, we're talking to a lot of firms, and firms, some of the larger firms are working on building out their ESG practice areas based on these many, many marketplace factors. And you also have the Inflation Reduction Act that passed last year that had a few $100 billion of credits related to the environment and climate. So that's another factor that's kind of driving this whole category. And once again, if you see questions coming in, it doesn't really matter where you stand on this, if you're for it or against it. This is just something that's going to require information reporting by businesses, and clearly firms can play a key role in that. And obviously people that are in the finance departments are going to play a key role in gathering up this information to do this reporting. So here we have one more slide on a lot of advocacy work related to the tax area.
Yeah, our tax team has had a really busy summer so far. They have sent a number of letters to Treasury and to Congress related to a number of different issues that those on the town hall may be interested in, some related to disaster relief. We've talked about the 1099-K issue before. Eric, you mentioned the Inflation Reduction Act. This was a change that was put in that would change it from $20,000 or 200 transactions to $600 or just a single transaction. Legislation has been introduced that would increase that lower threshold. And so we've sent a letter in support on that. We've also talked a lot about Section 174 on the town hall. We know a lot of people care about that. We hear a lot from practitioners on this issue. We are continuing to advocate on it and to follow it. Unfortunately, I don't have good news for the town hall that we're going to see any legislative action on the House or Senate floor before they recess in August, but it's something that we are hopeful that we can see some activity in the fall when they return back from the recess.
Well, thank you, Rachel. A lot covered there. Look forward to having you back during open forum. So thank you. With that, I'd like to introduce Jean Marks. Welcome, Gene.
Hey, Eric, how are you?
I'm great, and it's great to have you on the town hall. Gene was on the town hall a while back, and he's someone who I think most of you know. He is a CPA. He's running a practice. He supports 600 plus clients with some technology services and implementation services. But he's also one of the most widely sought out small business speakers. He has written columns for the New York Times and Washington Post and been on MSNBC. So it's great, Gene, to have you with us today. And what Gene and I are going to do is we're going to discuss a number of small, you could call them small business trends, or just the environment that small businesses are operating in. So Gene, you live this every day with these clients and with the broader marketplace. Let's start off with something that everyone's been talking about for the full year, but in particular the last couple of days, and that's inflation. And you call this sticky inflation. We got some good news yesterday and today about the CPI and PPI, but what are you seeing, and where do you see it standing right now?
So it was good news. CPI is down to around 3%, 3 to 4%. Still has a way to go before it hits that 2% level that the Fed is targeting. Excuse me. And PPI, the producer price index, wholesale prices, which is really the gauge that I focus on because that's the leading indicator, that fell to a 0.1% annual rate this last month, which is the lowest that it's been in a number of years, which is also great news. My warning, though, if you're watching or listening to this and you're servicing your clients, is to go out and say to your clients, like, hey, I see that inflation is down, so that's great news. You're probably going to get a different response from a lot of your clients because of all the associations that I speak to in just about every industry, Eric. Although inflation is trending down, the core costs that make up PPI, I'm talking about building materials, industrial chemicals, manufacturing costs, concrete, utilities. Most of those costs are still up in the double digits when you compare those same costs to just 2 years ago. So when I'm talking to my clients and the people at the associations that I go to around the country, they're happy that inflation is trending down, but they're still struggling right now, Eric, with a cost structure that is still significantly higher. And I think they need help from all of us to help manage those costs and forecast better around that. So the good news is that it's trending down, but we're still nowhere near, out of the woods when it comes to inflation. I hope that makes sense.
It does make sense. And I mean, there's still in the throes of it. And this is, significant price increases related to their different inputs, whatever business they may be in. How many of them do you think have addressed it, properly? Have addressed these increases in costs in a way that's supporting their business model going forward? And when you've been talking to these small businesses, how challenging has it been for them then to raise the prices for their services?
Well, I can only share with you what my smartest clients and my smartest readers are doing. Okay. The people that have been running businesses for years. For starters, they are raising prices. So they are reacting to that new cost structure. But, Eric, they're using something that our parents and grandparents did not have 40 years ago, in the inflationary times of the 70s and early 80s. Most small and mid-sized businesses have a lot of data nowadays. I mean, they've got QuickBooks and Sage and Epicor and Dynamics and whatever system they're using. So my smartest clients and my smartest readers are looking specifically at that data, and they are targeting their price increases. So instead of just having that across the board increase to everybody, they're focusing maybe on certain industries that can absorb it, certain customers that can absorb it. They've got great customers. They might not be raising prices at all. They might have that customer that they're not so crazy about. They're raising prices a little bit more. So they're being very, very good and targeted, leveraging their data to implement those price increases, and they're leaning on their financial professionals to help them do that. So that's number one. The second thing that I see a lot of business is doing is they're practicing shrinkflation, Eric. I mean, they're offering a little less, but for the same price. So they're no longer including shipping like they were before. Or if they're shipping out parts, maybe there's one less part in the box than they used to ship, but they're keeping the same price. And they're taking cue from some of the biggest brands in the country that have been doing this for years. And it's a pretty good inflationary tactic, where people are, it's like you go out to the restaurant and you're getting 3 meatballs instead of 4, in your dinner. Cost the restaurant owner a little bit less, but you're not seeing an increase in the price on the menu. So a lot of customers, they don't realize that's going on. So
yeah. I mean, and I just this morning I heard the update from PepsiCo on their results. Interestingly enough, their revenue was up because they raised prices. Their gross margins were up because of doing a number of things about probably what you're stating, kind of maybe reducing the number of things that were in some of their, paper potato chip bags or things like that, or just
I'll give you an example.
Structure.
Yeah, you mentioned potato, like a bag of Doritos used to be 9.75 ounces, and now it's 9.25 ounces, but it's the same price.
Right.
So it's just that's one small example of big brands that are just making these adjustments. These are smart people. So my clients look at those big brands and they're like, okay, we should be doing that the same in our business. And so that's some of the tactics that they're using to navigate their way around so that they can get themselves on an even footing in a higher priced environment.
Okay, well, let's keep going. Questions coming in here. I'm going to ask you a question about cost of capital and what your clients are doing related to their financing needs.
So first of all, I'm sure for all of you watching this, if you're having clients and they're going back to their banks, we're talking about existing clients now. Like I have family-owned businesses, manufacturers. The bank prime rate right now is between 8.25 and 8.5% around the country. I mean, it's well more than twice, even 3 times what it was just a couple of years ago. So, and even, that's for the best clients. So my clients are paying 9, 10, 11% on new financing. This is to refinance working capital loans, to buy new equipment, to buy property. This happened really fast over the past year, all this significant rate increase. And we're just seeing that impact now. It's really starting to happen. And I'm seeing among my readers and my clients, a lot of businesses really reevaluate investments that they're making. I've had a few clients that have put off the purchase of some equipment or buying a piece of property because they're like, a year ago we could have afforded it, and now, because of interest being what it is it's not something that gives us enough ROI. So I'm seeing a lot of that, and that concerns me. The Federal Reserve recently reported that most corporations, large corporations, their borrowings have decreased significantly, about 20% over the past year. And a lot of that is directly related to the increased cost of those borrowings, these higher interest rates. And higher interest rates like this are going to be around for a bit. They're probably going to go up a little bit more if you listen to Fed Chairman Powell. So, if you're talking to your clients, they have to be prepared for at least another year of a high interest rate environment. And not that they shouldn't be borrowing, but they have to really get some help to determine whether or not it really makes sense to do what they got to do, if there's enough return on investment. And again, that's another opportunity for all of us as CPAs.
Well, and you and I before the show were talking about, the firms playing for the small business a little bit of this treasury services role.
Yeah.
Where one, we just talked about financing and, making sure you've got the right financing options. And there's probably at times this opportunity to work with banks and fintech, like the Ann story. But then you even were mentioning if there is some, spare cash, to take advantage of things. And this is not assets under management, just to take advantage of some of the good rates in CDs and money markets.
100%. I mean, again, I realize that a lot of us are not wealth managers, but we do partner with wealth managers. And to say to a client, I mean, money markets right now have finally caught up, and many of them are paying between 4 and 5% interest. The same thing with treasury bills and treasury, treasury instruments, as well as certificates of deposits are paying even more than that. There's a liquidity issue. I mean, you don't want to make some of the mistakes that, say, like a Silicon Valley Bank made. So, if you're going to be parking money away to get the best return, you want to make sure that it can stay non-liquid during that period of time. You can also ladder these investments, maturities rolling every month. These are the kinds of things that a lot of my clients just don't have the time or sometimes the resources to figure out what makes best for them. And it's an opportunity for us as CPAs to advise them and then maybe connect them with a wealth manager who can then carry the ball from there and make the investments for them. But I think our client's biggest need is saying like, okay, Gene, they come to me and they say, if we do want to take advantage of, say, a certificate of deposit, how much money can we park that we won't be needing in the next 3, 6, 9 months? And if you forecast the right way and help them do that, you can help them take some of that money and put it away, and they can really earn and take advantage of the higher interest rates. So it's an opportunity for us.
Well, some good advice there. So, I mean, you're speaking with businesses all across the United States. So where do you see, the recession? Is there a recession? Is there a mild recession? You and I were discussing this as well. Well, it depends. It depends where you are, and it depends what industry you're in.
It depends, and it depends, and it depends. And we were talking earlier. There's this great map out there. There's a guy named Mark Perry. He's an economist for the American Enterprise Institute. He's a professor, I think, at the University of Michigan. And he puts out this map. It's like a map of the U.S., and it shows all the states in the U.S. and the comparable GDP of countries. And like, for example, like the state of California has got like a bigger GDP than the UK. And the state of Texas has a bigger GDP than Canada. And Florida has a bigger GDP than Mexico. North Carolina has a bigger GDP than Sweden. And I only mention that because ABBA is from Sweden and they're like my favorite rock band. But we live in a big country. So when people say, are we in a recession? You can't just say yeah or no. Some regions are doing better than others. Florida, Texas, we know have been doing well. Illinois and New York, they've been lagging. Some industries have been doing better than others. I mean, manufacturing has been down for the past 6, 7 months. Tech industry, we know, has been having lots of challenges. Certain parts of the construction industry also challenged, but retail has recovered. Restaurants have recovered. Services industries are through the roof. We had more travelers through the airports, according to the TSA, the Friday before July 4th than ever before. So the travel industry are doing fine. So some industries have recovered fine, doing good. Some are struggling. Some regions better than others. It's just sometimes it frustrates me when you watch the main news and they're like, are we in a recession or not? And the answer is it really does depend. It really does.
Well, it does. And the resiliency of the U.S. economy. I mean, back at the throes of the pandemic, when Warren Buffett was selling airlines, and look at the airline stocks now, they're back and people are flying more than ever. So that's some good perspective. It really depends where you are and what industry you're in. There's a lot of talk of this Biden economics or Bidenomics.
I have a hard time pronouncing that as well. I think it's Bidenomics.
Bidenomics. Right. But the opportunities here. So Jamie Dimon, the CEO of JP Morgan Chase, was talking about that earlier this week, where we already mentioned in this town hall the Inflation Reduction Act, the IRA Act, and the few $100 billion of subsidies, credits that it's got related to climate. You've got the CHIP Act. So I know this is something you've been thinking about and talking to clients about.
So first of all, for everybody out there, okay, I don't care if you're a Republican or a Democrat. Don't care what your political leanings are. My smartest clients, and I learned from them. They have taught me that they make their opinions known in the voters booth, but they've got businesses to run, and they've got employees and customers and partners and their families that rely on them to make good business decisions. So whether or not you agree with Bidenomics and the amount of money that the administration and Congress has been spending, that's put that to the side. It's an opportunity. And, since President Biden has become president, there's been $1.7 trillion in legislated money that is right now being spent. The chip industry is getting $300 billion right now for major chip manufacturers to build out chip manufacturing plants. The Inflation Reduction Act is for all sorts of different uses for companies in every industry that are doing their bit for the climate and the environment and being green, as it is. And then there's the infrastructure bill, which again is $1 trillion to, repair roads and airports and all the things related to that. That's opportunities. So, of course, I have people in the construction industry that are going after that, but even the chip building plants that are out there, they need marketing people, they need landscapers, they need people to paint the walls. They need pizza shops nearby to feed their new employees that they're hiring. So I have clients that are looking at all of those bills and spending time going through it. And just to give you an example, I don't know, Eric, if you got the slide on the infrastructure. Yeah. So like this is like a perfect example, of like I have one client in particular. I'll give you, they hired an intern this year, and all this person is doing is going through all the funding. This is a manufacturer, by the way, but they manufacture materials that can be used in different building products. And they're going through all the different places where you can get funding through the Infrastructure Act. And there's a bunch of different websites, and I included just a few of them, just to to give an example. But it is a place where people can go. It's time consuming, so you have to apply for the funding. You have to follow up on it. You have to figure out that's why everybody is not doing it. But the smart businesses that are out there, they're getting help from their CPAs. They're hiring assistants. They're going through all these different places, that are available. Here. Thank you for the slide. That's great. These are just a few examples of the places that are out there. And by the way, I've got like 3 slides with more examples. I didn't want to bury us all in website links, but it's just an example, everybody, of the amount of money that's out there and the amount of money that's being funded by different agencies of the government for all different types of businesses. And, people are following the money. And I will tell you one thing, the one manufacturing client that I have in Trenton, New Jersey, that hired an intern to go through all of this stuff, the 2 owners of the business are like solid Republicans, right? Not big fans of President Biden, but they're also smart business owners. And they're like, hey, we could be selling, the money's out there. We're going to sell into these industries and take advantage of some of the opportunities here. And that's what we should be helping all of our clients do.
Well, Gene, we can drop this slide now. I mean, but there's a lot of good resources, good information. It's very smart to have that intern looking at what are the opportunities for that manufacturing company. There's questions coming in. How can small businesses take advantage of this? I think you gave a lot of good examples highlighting that. And you have more, and I think this is something that we want to further unpack for the town hall community. There's people that are concerned. Comments coming in concerned about the the $1 trillion plus dollars that's being spent in these industries, but it is being spent, and one way to kind of get the government a return is to build businesses, and those businesses pay taxes, and that's one way we'll be paying off some of these investments.
Yeah, so, and I do want to say, I don't want to trivialize this at all. It is a concern as well. We're all concerned about the national debt and all that spending, but like you just said, it's been done. So we got to do what we got to do to run our businesses, and these are just opportunities out there.
Well, this is something as we always do with these questions coming in, we'll highlight those links in our follow-up newsletter, and it is in the materials for today's town hall. And so, Gene, it was great having you. The one comment that did come in was, they're not sure if ABBA is a rock band. I enjoyed listening to ABBA. So besides that,
that's debatable.
That's debatable. So we look forward to having you on again. Thanks for your insights. Thanks for being a great CPA leader in the United States. And we'll be talking sometime soon.
Thanks, Eric. I'll see you in New York.
Yes. We'll have you in our studio. Thank you. So with that, I would now like to bring up Melanie to review some technical updates with us. Melanie is doing twofold, double duty here today. She's going to be providing Lisa Simpson's technical updates, and then we're going to talk about beneficial ownership. So welcome, Melanie.
Thank you, Eric. And I'm going to dive right in because we have a lot to cover. So we'll start off with IRS notices. collections have started, and we've already heard there's issues. We have heard specifically that the IRS has started to process 1040 and 1041 returns in May. However, they're now sending out notices to people saying that their payments are late, even though the checks were cashed in April. So we've reached out to the IRS. We've made them aware. We're hoping to clear this up pretty quickly so that more people don't get more notices. Also, e-signatures, some good news there. The IRS has announced, and they actually put it up onto their website, that they're working to extend the temporary e-signature relief, which would go beyond October 31st deadline. So great news on that front. We don't know how long they plan to extend it, but they've also said that a permanent solution is important for them. So we're hoping for good news on both the temporary and the permanent front. So disaster relief, something that impacts most people at one point or another. Vermont, unfortunately, they're having floodings, and they had floods that started on July 9th, and they're still continuing. On July 10th, they declared an emergency declaration for the area. And that's a good sign, because that's usually the very first step for it to be declared a presidentially declared disaster, which is where people get the filing and payment relief. So hopefully soon, keep in mind there's a couple steps to go, but hopefully soon they'll be able to get filing relief. Also in disaster relief, the IRS, well, there were about 1 million people who owed taxes that were in disaster areas, and the IRS actually sent them notices saying that the payments were already due. And we spoke with the IRS, they recognized the mistake, and they actually started to send special filings because they did try to fix it. And what they did is on the CP14, all the way, one little paragraph on page 4 of CP14 said, oh, by the way, you could be in a disaster area and you're not late. That only just created confusion. And so the IRS then had to send inserts and flyers to people. But of course, people are already panicked because they had already received the notice. And actually yesterday, the National Taxpayer Advocate came out with a blog discussing this issue. Okay, the WISP. Lisa has talked about this, has brought the importance of this up to you guys multiple times, but I did want to share an example and a story that we heard from a Georgia Society CPA's Federal Tax Committee member, where a small business practitioner, they were actually going through an audit, not associated in any way with the security plan, and the IRS agent asked them if they had a WISP in place. And they didn't, and they were hit with large penalties. Now, you have to understand the requirements, this FTC safeguard requirements are through the Federal Trade Commission, and their penalties are different. And when you get hit with those penalties, they're sizable, as in like thousands of dollars, and they're per incident. So it adds up really quickly, really fast, and it gets ugly. I've also heard that about 68% of accountants, I've seen those statistics out there, are unaware of the FTC safeguards which dictate this written information security plan. We also realize there's some confusion out there with the exemption, the $5,000 or $5,000 exemption. Some people are thinking it's per client. The regs, the way they're written, it's per customer. So you could have one client that could potentially have 5,000 customers, and you could potentially not be exempt. Another clarification point is, just because you meet that requirement for that exemption, it means it is an exemption from certain parts of the written information security plan, not the whole thing. So please be aware, educate yourself. We have a landing page, resources. We have some great resources available for everybody. We also have some locked content, but we're also working on more resources that would be available for everyone. Moving on to a recap of the filing season. So Erin Collins came out and she said, what a difference a year makes. Overall, the difference between the 2022 filing season and the 2023 filing season was like night and day. So clearly we saw improvements, and that's great. We're happy about that. But before we jump into the details and specifics about those improvements, let me give you a few stats so that you can keep the landscape in mind. Okay, so in comparison to prior year in April, the amount of returns that IRS received dropped about 1.3%. However, the self-prepared returns, those dropped over 2%. And those returns prepared by practitioners, those have stayed flat. And of course, the extended returns, those all mainly are coming from tax professionals. So that's a good news for us. One thing, when you look at the slides up here, we're going to cover two aspects. There is the mid-year report to Congress that Erin Collin puts out every year, and this is where she has her highlights of the filing season. And we also do an IRS services survey for all of our membership. And it's interesting because between the two, they definitely weave together and they definitely echo each other. So what you see here are those numbers where you see that dissatisfaction went down 30% from 74% to 44%. A lot of people are feeling better about the IRS. And the satisfaction, it went from 7% to 24%. And that's our membership. So that's good news. And we're going to cover the good news, but the devil's in the detail. So let's go on to the good news first. Okay. So as you can see, the IRS definitely caught up on processing paper-filed 1040s and various business returns. So you can see 13.3 million, and it dropped down to 2.6 million. Now, that's a pre-pandemic level, so that's really great. And the IRS was able to achieve that because they're piloting new technology programs to help them get through it. So fabulous news on that front. Refunds, also great news. During COVID, there were over 10 million people who had to wait over 10 months to receive their refunds. 2023, 90% of the people who e-filed received their refunds timely. And timely, of course, for the IRS has to do with the 21 days, in hopes that people will get that within 21 days. Now the calls. Again, we saw dramatic improvements here, where 2022, 7.5 million calls were answered, and the wait times were about 29 minutes. For 2023, they increased their calls, of which they answered to 11 million, and their wait times were only 8 minutes. Okay, but now we're going to get into the detail and the bad, because despite all of these improvements, there were still some problems that carried over. Let me give you guys a little bit of history from the trends in the surveys that we've done, because we started to follow the trends in 2015 and definitely have the stats from 2016 on. So in 2016, if you recall, that was really like the rock bottom, the low point for the IRS. And that's when Congress decided to provide money to the IRS so that they could start answering the phones, picking it up, and seeing improvement. And we did. And we started to see the trend of improvement year after year. Taxpayer First Act came out, and they were really doing well, and the trend was fabulous. Then COVID came and it tanked everything, and it tanked it below the rock bottom. So when we look at our statistics in our member surveys, yes, we did see improvement from last year. However, when you look at the big picture of improvement, we're slightly improved above what we were in 2016. So there's a lot of room to grow, a lot of movement that needs to happen. But the good news is that the trend is now moving in the right direction. Now, some specifics where we saw the biggest problems. They had to do with processing amended returns and answering of correspondence. And the reason this was such a problem is because a lot of the people that they brought in to answer the phones couldn't handle processing those returns. And our surveys echo this with the same information that we're seeing. Now, the IRS was directed to answer 85% level of service in answering their telephone calls, and they did achieve that, and they've been touting it everywhere. However, this is it bugs me when this one. That number excludes 73% of all the calls the IRS received. So it doesn't include, for example, 8.5 million calls in which taxpayers didn't want to wait on hold, so they went ahead and hung up. It also doesn't include the 6.9 million people that ended up with automated responses. So big picture, 34.5% of all calls were answered. And also the IRS doesn't measure the quality of the service that people are getting once they answer the phones. And from our data and statistics, we see that 42% of the people who were able to get through to the IRS, only 40% of those people were able to get answers called. So what does this mean moving forward? Like I said, IRS funneled a lot of money and people into hiring employees to answer those phones. They've actually used up $1 billion of the IRA funding. So the IRS does need to focus on technology to help. With that, they need to focus on a Tax Pros online account. They need to be able to e-file all tax returns. We need to have the ability to receive and submit responses online. Now, the IRS does have an operating plan, strategic operating plan. There are some concerns. Aaron Collins said it, and we echo it, is those goals are very ambitious. And so if they aren't met, there could be problems. However, overall, and if you could move to the next slide too, overall, you would see that Aaron Collins is very hopeful for the next 3 to 5 years. So with that, and due to time, we're going to jump right into beneficial ownership of information. So what it is, you guys have heard Lisa talk about, it's very important. And the way it comes about is beneficial ownership of information is an anti-money laundering initiative. So what they're trying to look through are the shell companies. So you have a business that's owned by another business, and another business. And what they want to know is who from this business is the ultimate beneficial owner. So they need that information. Now, who qualifies for this and who has to apply? It's a huge scope. FinCEN has estimated 32.6 million filings will happen in the first year, which means most businesses will be impacted. Yes, there are some exclusions, but for those exclusions, I'm sure you've heard, you need 20 plus employees or $5 million in revenue or larger. Those 23 exclusions, most of them are also already heavily regulated. So most people aren't going to qualify for it. And the trigger of whether you need to file the beneficial ownership of information reporting form has to do if you filed with the state secretary for formation or creation of the state. So sole proprietor filing through Schedule C, most likely don't need to file. So the rules and how does this work? If you are an existing company, right? And existing is defined as before January 1st, 2024. Then you have 1 year to file, January 1st, 2024, all the way through January 1st, 2025. If you're a new entity, defined as if you're created on or after January 1st, 2024, then you've got 30 days to file, really strict. Additionally, if you have any change in information, so one of the owners moved their driver's license, something changed on it, or percentage of ownership, or a new person came into the business, you've got 30 days to file. Now, the 30 days to file, if you move, that's what the triggering event. But for the new entities, the real trigger for that has to do when you receive notice from the state of the creation, registration, and formation of your entity. Penalties. Those are really ugly. The penalties are $500 per day, up to $10,000, and 2 years of prison time. Now, it's for willfully not filing, but willfully is kind of a ambiguous term and up to somebody's discretion. So there's lots of concern there with regards to this. And that's why awareness is such an important issue, and we are really pushing it through. Something that our members need to be aware of. So non-attorneys, there is debate that if you are providing advice, kind of like as to who a beneficial owner is, because that's not always straightforward. In theory, it's 25% or more ownership, but if somebody has substantial control of the business, they're considered beneficial owner. So if you're providing that type of advice, it could be considered unauthorized practice of law. And that is something that is determined at the state level, not at the federal level. So we highly encourage people, reach out to your state regulators, reach out to counsel, reach out to your insurance carriers, because we've heard some insurance carriers in some states have already said this would be UPL, while others have said, we'll insure it, not an issue. Now, we've had conversations with the ABA. We've asked them to have conversations with their state tax areas of the ABA. And the general consensus is, one, they don't want to file the form, and two, they don't see this as UPL. But there's nothing out there guaranteed. So please take precautions with that. Now, with all this in mind and all those penalties, the AICPA did come together and pull together a coalition. We really are trying to raise awareness because of those steep penalties, because this is so unknown. Most people aren't even aware that FinCEN exists, most of the taxpayers, much less this obscure requirement that they have on for them. So a couple of things to Beyond the Coalition, which we have been putting out information consistently, and you will hear from us through at least the end of the year on this issue. But right now, what we're doing, the bill just came out. HR 4035, which is pushing and asking for the delay of implementation until all the rules under this regulation are finalized. Right now, the first set of rules is final. The second is proposed. We haven't heard anything on the third. So it would make sense that it got delayed until everything was final. Also, we're submitting written testimony for a hearing in which came up, and the hearing is next week, because the topic of small business being ready for this is kind of a concern. And we've actually been continually having conversations with FinCEN. We actually gave them a scolding because they've done nothing really to raise awareness. They have a few web pages on their website, but again, a lot of taxpayers don't even know who FinCEN is, much less that this reporting requirement exists. So we've been talking with FinCEN, we've been talking with everybody that we can, and we're pushing for raising awareness. In this slide, one thing I do need to note, the reporting requirement isn't this quick yes or no, here's my name, address, information. What the Federal Register came out with was 51 plus questions, and then there are sub questions to it. So this is not an easy, quick, hey, yes, this is my business, this is who owns it. So please be aware of that. And of course, we have a fabulous landing page with lots of information for you guys, resources for your clients, resources for yourself, for you to get educated. We have articles, podcasts, you name it. We're putting information out there, and we're still developing the information.
Bring you back. Well, Melanie, that was fantastic. And you know, I didn't give you your title when you first came on. Melanie's the Director of Tax and Ethics at the AICPA. Melanie Lauridsen. So very, very well done. We've got a lot of questions that have come in related to benefit ownership information reporting. Who do you think is, you know, who should be doing this filing? I mean, the client, the firm, law firm, the attorney, how are you seeing this?
The lawyers don't want to touch it at all, period. Like they just don't want, and they don't even have that type of information. If you really think about it, who has access to this type of information? It's us, right? We work with those businesses and those entities. And the intention of FinCEN was for practitioners, tax professionals to be able to help and support that. Unfortunately, they weren't thinking about UPL. And we've brought it to their attention too. And when they heard it, they were like, oh, yeah, we'll see what we can do. But again, FinCEN doesn't have the authority over the states. So I'm hopeful that FinCEN will put something out there that will give the nod to the states that we can do this.
Well, this is something, I mean, that clearly a lot of the attendees want more information on the process. Even some people are having issues accessing the form. Is the form live right now?
FinCEN? No. So what happens is FinCEN puts something in the Federal Register, and in your attachments for resources, even for now, the town hall, you should have a PDF. It's 2 pages long. And so what we did is we converted that so that you can see what it is in a visually more easier way to process this form. It will be online, similar to the FBAR.
Okay. Well, what we'll do is, Melanie, I look forward to you and your team reviewing the questions that have come in, and we'll definitely in the newsletter next week summarize those, and then also, as you said, this is a topic that we'll be talking a lot more about in future town halls. So thank you. Rachel, welcome back. And we do have a number of questions that have come in. So let me give you a question related to just maybe once again, you know, a number of people wanting to anything that they can do related to Section 174. I mean, some people might have missed it, but just they said, sorry, I might have missed the update. Can you just review again? This is really, really important to my clients.
Yeah, this is an issue that has tremendous bipartisan support. At the end of last Congress, it was considered to be included in the last must-pass vehicle but ultimately it wasn't, because it got attached to some other tax legislation related to extenders and the enhanced child tax credit. But there continues to be a lot of support for this. The House Ways and Means Committee marked up a more comprehensive tax bill in June, and it included Section 174. And now there are discussions on bringing that bill to the floor. It doesn't look like that's going to happen here in July, but there is hope that it could happen in the fall. But again, the problem is it's not going to go as a standalone bill. It's going to go in a larger package. And this is not controversial, but other pieces within that package are controversial, and that's what's holding it up. So we and many others are working hard on trying to find a vehicle and avenue to get this legislation passed as soon as possible. But it's not without a lot of support from both House, Senate Republicans, and Democrats.
Thanks, Rachel. So regarding to the beneficial ownership information reporting, not for profits, financial partnerships, just more specifics on who will be required.
More specifics. So think about the larger firms, they get the exemptions. And of course, those that are regulated. So like SEC clearinghouses, they already have regulations on them. Not-for-profits already have reporting requirements. So those types of entities are out. LLCs, definitely. So if you think of our membership base and CPA firms, a lot of those too would also be required to file.
Okay. Well, thank you. We're now, up to about 60 questions on beneficial ownership information reporting. So we'll be reviewing those. Rachel, also a lot of kudos to you today for your update. So Rachel, Melanie, thank you for both being with us. Thanks for Gene Marks being with us as well. So let me now just kind of run through our closing slides. Here's in summary, a lot covered today. So please take advantage of these slides, use them with your other members of the firm or your company and with your clients. We're calling out two resources here. We've got a financial advisory white paper talking about some of the things I spoke with Gene Marks on related to financing and options for your clients. And then another category that continues to grow in interest, it's a new category, it's called Spend Management Advisory. It's a component of the client advisory services offering. And more businesses are looking to move from expense management to spend management. It's really, so it's a new way of thinking about how you want to manage those credit card expenses in a much more proactive fashion. So we've got a survey that went out to 750 small businesses, which you can access. And we've got a webinar, which goes into that in some additional depth. Next week, in 2 weeks, July 27th, we'll have the next town hall. We should have Lisa Simpson up there because she'll be joining Barry Melanson, myself, and the CEO of Shellman, Avani Dasani. And then on August 10th, we've got Lisa Simpson, we've got Aon back for their quarterly update on professional liability, best practices. And then we're going to have Dr. James Johnson from the UNC Business School talking about some very interesting demographic trends. I think you'll enjoy the session with him. We've got the on-demand highlighted here, so take advantage of that. Today, we had close to 8,000 attendees, and we're getting a couple of thousand viewers via the on-demand every week. So we really appreciate your engagement. Here's the next two town halls. Have a good end to the month of July, and look forward to seeing you again on July 27th. Thanks for attending today.
Thank you for your participation. You can now subscribe to the AICPA Town Hall Series on your favorite podcast platform, as well as watch archives on YouTube and AICPA TV. Tune in for live broadcasts Thursdays at 3 p.m. Eastern Time.